Okay, it looks like we won't be able to get on Facebook Live, but please let anyone you know that wanted to catch this that wasn't able to see it to log in today and register that it will be available by Zoom um, on demand. So let's get started. I don't want to hold you guys up anymore. My name is Sarina Mohan. I'm the Director of Public Programming and Events for the Preservation Resource Center. And I would like to just thank everyone for being here today and coming together to learn about this. I want to thank everyone. I see some familiar names in the audience, people who have been coming to all of our classes this week or a bunch of our different classes, and also members of the PRC. Just so you guys know, members are really what make the PRC tick. You keep us alive and we love you. So thank you, thank you, thank you to all of our members that are in the audience. If you're not a member of the PRC yet, please feel free to join anytime. You can join at prcno.org. And if you would like to support us in other ways, we also have merchandise available. We have an amazing coffee table book. We have t-shirts for sale. So please consider making a donation to the PRC. That's what keeps these programs free and open to the public and available. And we want to be there for as many people as possible while everyone is stuck at home, so you guys can learn about your historic properties and how to take care of them. So without further ado, I want to get us started. We have an incredible panel of experts here today. Joe Uzee is a mortgage lender and VP with Gulf Coast Bank and Trust. He has also been a part of the PRC's education team and has been volunteering to teach classes with the PRC for over a decade. And he's going to tell us a little bit about sort of what's going on with lending and sort of big picture stuff. After that, we are actually adding something. We've done this class one time before a couple of weeks ago, but we're adding in a commercial aspect. The commercial market is absolutely a huge piece of what happens with real estate. The commercial and the residential markets really play into one another, particularly in this town. So Gordon McCloud is a commercial realtor with McHenry and is also a board member of the PRC and is a wonderful resource and is going to really talk to us sort of about what's going on in the commercial market in particular. Katie Witry is also a board member of the PRC and is with the Witry Collective. And again, both of them have been involved in PRC education programs for a very long time. They know their stuff. Katie's going to talk about the residential market. If you have questions for any of them, feel free to ask them. I will sort of ask them as we go along. And at the end, we'll have a little bit of time for Q&A. They may sort of, have some dialogue with one another that'll build on that. So Joe, I'm going to turn it over to you.
All righty. Thank you. Happy Friday, everybody. So start with mortgage. I always like to talk about interest rates. That's actually good news. A little bit different than 2 weeks ago when we had our first session. But it's good news because we have stability, at least for right now, and anything can change. But based on the economic environment that we're seeing right now, rates should be where they are right now. When we have low rates, typically there's some turmoil, there's some distress in the market. So low rates, although it's great when you're buying a house, usually there's other factors that are negative. But based on the environment, rates are where they are, about 3.3 on a 30-year fixed. I'm not going to get into different scenarios if you were purchasing an investment property, multifamily, second home, primary residence, all of those rates change. But if you're looking at where are 30-year fixed rates, we're at about 3.3, right below 3.5. Those are excellent interest rates, okay? The good news is that they've been staying there. We may have a day where 3.5, 3.6, but 2 weeks ago, we were jumping from 3.5 to 4.75 to 4 to 3.8. So the stability has occurred. And you may ask, well, how come? What happened in 2 weeks? Remember, the Fed is our friend in all of this right now. Okay, sometimes the Fed does things historically that, why did they do that? Look what they caused. But in this pandemic, the Fed is actually our friend. They were actually too good of a friend, as I mentioned before. They went in with all guns blazing, and as a result, it caused some turmoil in the market. They've backed off on purchasing some mortgage-backed securities. So as a result, that stabilized the market. When they were buying up all of the mortgage-backed securities, That caused a lot of turmoil for the normal bond investors who purchased the mortgage-backed securities. And it also devalued the servicing. So we're seeing some stability in there, and that is all good. The Mortgage Bankers Association, their projection for the rest of this year is a 30-year fixed rate at about 3.4. It may go a little bit down, could go a little up, but if we're stable, investors love certainty. So if we stay in that range, that is an excellent interest rate that will carry us through the rest of this year. And into next year, they're projecting maybe a little bit lower than 3.4. But in any case, those are excellent rates. So we talked about some good things. Let's talk about the economy, right? So it's a little bit of negative news. Right now, 22 million people have filed unemployment. Probably is more than that, but right now we'll go with 22 million. That 22 million figure occurred within the last 4 weeks. The most recent week, it was about 5.2 million. So the trend is upward right now. We're starting to see that. Maybe there were a lot of companies that were saying, hey, I'll pay you through this. And now we're 30 days into it and they're realizing, hey, to keep you, I have to furlough you, I have to cut your salary. So we are definitely seeing a negative trend in unemployment. I also want to touch on forbearance. We spoke about that a few weeks ago. The current forbearance rate, which is home mortgage holders, not mortgage holders, but the borrowers calling up their mortgage lender and asking for forbearance. Hey, I can't make my payment. Okay, that is running at 4.1%. The norm in a normal environment is about a 0.23%. So that's a huge increase. That number equates to 2 million in forbearance. So we have 2 million mortgages in our country that are in forbearance right now. That's a bit of a negative. The reason is, remember what I said, the servicers, the companies that accept the mortgage payments, they still have to pay their investors. So if they're not receiving the mortgage payments, then that causes a little bit of volatility and influx. So those are two negatives that I wanted to touch base on: unemployment and the forbearance right now. I'm a half full guy, right? Glass is always half full. I'm positive. We're a resilient city. We've been through epidemics. We've been through wars and battles. We've been through many natural disasters, hurricanes. We've been through economic downturns. So, but I always like to say that the glass is half full, and we've always recovered as a city. On a United States level, I truly believe that the United States, the people of the US, they are ready to get back to work. We're ready to get back to some normalcy. We're ready to get back out there and get to a normal. We know it's not going to be normal, but they're ready to get back to work. Despite the drive that we may have as US citizens and as New Orleanians, we cannot overlook the economy. The 22 million that are unemployed right now in forbearance, okay? Data shows that through the Depression, I'm not going to touch on every major downturn, but we had a depression in our country. We had World War I and II. We had the dot-com crash in the 2000s. We had the housing crisis in 07 and 09. When you look at the people who are a lot smarter than me, and I've read what they've written, out of every one of those downturns, there's some growing pains as we come out. And this is not going to be any different than those times, okay? Their data shows that there will be another US-wide housing slump, okay? It won't be anything like 07, 08, and 09, but it still will be painful. The reason is that there is overvalued real estate right now, okay? Part of that is due to the low interest rates that we've seen over the last several years, okay? We've had historically low rates really for the past 5 to 6 years. In 18, we hit 5, but other than in 18, we've been in the 4s, low 4s, and those are historically low rates. So because the affordability and interest rates were there, that has driven up housing. And I'm not just speaking New Orleans area, I'm talking nationally. So there is some overvaluation in real estate. I mentioned several weeks ago, and this has not changed, the jumbo financing has dried up. All right. You can get your conforming loan, which is 5, 10, 400 or below, but those loan amounts that exceed that, that's considered your jumbo, non-conforming. Those are not backed by your Fannie Mae and Freddie Mac. Those are actual banks or investors. That financing has dried up. Qualifying for a mortgage is a little bit more difficult, and let's talk about that. So I want to pose this question. Is it any different than it was before COVID-19 to get a mortgage? The answer is really, the short answer is no, it's not. I am going to interview a client and take their loan application just as I did before. There's 4 components to a mortgage. This is Joe Uzee simple. What do I have to do to get a mortgage? And I like to break it down. CICC, credit, your income, the cash to close, and the collateral. All of that's the same. But I'm going to mention a nasty word, and that's called overlays. Some of you may have heard that word before. In 07, 08, and 09, that word was definitely prevalent. Overlays are additional criteria that the investors, okay, the lenders, put on the loan in order to get it qualified or approved. All right. So I'll give you an example. 5% down payment. Okay. That's the requirement. Just giving a hypothetical, 5% down. Investors may come in and say, I'm going to put an overlay on that and say, I want my down payment to be 10% to make that a better loan, a stronger loan. So there are what's called the overlays, but the credit, the income, the cash to close, and the collateral, that hasn't changed, but there is a little bit more stringent requirements in order to get a loan. So over the last several weeks, we've seen lenders and investors implement higher credit scores to get mortgages. Income verifications have become, lenders have to go through much more scrutiny when we're evaluating one's income. The cash being used. This is a big thing. If some investors are requiring more down payment, right, then you're going to deplete your cash. However, in this environment, potential home buyers have been depleting their cash if they've been unemployed, okay, or the spouse is unemployed and the other, spouse is still working, or partner. They're using some of their cash, so that cash is being depleted. And also, if you've had your money in the stock market, that has been depleted, okay? The collateral is the appraisal, all right? You can't control that as a buyer or a homeowner, but remember what I said. If there is going to be some devaluation in real estate, that could become an issue when you're looking for your house, when the mortgage is trying to get approved. I think that in our area, we're not going to see a plummet in home values. That's just my opinion. Katie and Gordon are going to dwell in on that or chime in. But what we aren't going to see is a great appreciation. So if we've seen a typical 5% appreciation over time, that appreciation is going to ratchet down to maybe a 1% appreciation. Okay, we won't necessarily see a plummet, but the values won't appreciate as much. So what is the impact on those points that I just brought up? Closings. Expect delays in closings. All right. Nothing major, but expect them. Investors and lenders, we have to do extra income verification at the end. And that's the big thing, right? So normally I ask a client for their paycheck stubs, and they're good for 2 months. I don't have to bother them again. We do a simple VOE at the end, verification of employment at the end. However, now in today's world, we're required to get their most recent paycheck stub. If we know that they got paid yesterday or this morning, if they got paid at the middle of the month and today was the 17th and they were closing a loan at noon, we have to get their paycheck stub that they got this morning before that loan can close. So those are little things that that could delay the closing. So as realtors and buyers and sellers out there, just expect some delays and be patient with it. The overlays that I was speaking about, unfortunately, I think that that's going to hurt the marginal buyer. Okay, so if we have the buyer who has a decent credit score, but not a great credit score, they're working with the minimal down payment. With the overlays that are coming in, they may have trouble getting a loan, unfortunately. And I know that nationally, there have been some investors. There's been a big investor. I'm not going to name the name of that bank, but they're huge. It's public. They announced it over the weekend that their minimum down payment is now 20% and their minimum credit score is 700. All right. They're doing that so that the loans that they book are solid loans. Okay. In their mind, that there's no, I don't want to say that there's no chance that those loans would have trouble, but the fact that if there is a big downturn in the future, those investors want to make sure that they have loans that were underwritten in a prudent way. And that's going to hurt marginal buyers. It just is. There's no way to get around that. I want to talk about PMI, private mortgage insurance, for a second. If you're putting down less than 20%, PMI is required on a conventional loan. We are starting to see those rates increase. Okay. The PMI companies are the insurance companies that will pay the investor if the loan goes into default. So these companies are looking into the future that, hey, we may be in this recession for a while. We may be in economic turmoil for a while. So obviously they're going to raise their rates to protect the insurance claims that they may have to pay out. So those are some things that you have to be cognizant of if you're in the market to buy, if you're a seller, if you're a realtor. Technology. In Louisiana, we are not in e-sign closing, at least on the mortgage side. I'm not talking about commercial, but on the mortgage side, residential mortgages, there's about 5 documents that you have to sign. But you are starting to see lenders migrate more towards what we call hybrid closings, which means that we can send out almost the entire package the day before closing or the morning of, where you as a buyer or borrower can go in and e-sign everything beforehand. And that cuts down on the time that you have to be at the title company, okay? So that's great for now, right? With the pandemic, nobody wants to go out, a lot of people. They're doing closings in their automobiles. The attorney's actually bringing packages out. Some people can go in, the title companies are ensuring that we're doing one closing at a time. So it's just the parties that are involved. They'll bring the sellers in later. So the title companies have been awesome through all of this, very accommodating. But the hybrid close is going to be very big throughout the rest of this pandemic and in the future. So when we get through this, I think that we're going to see, closings that are much more efficient because of technology. And that has been driven through this pandemic. So that's a good thing that's come out of it. It's forced us to get into a little bit more technology. But I wanted to kind of keep it condensed, but we're in a good rate environment. We have some economic issues, right, with unemployment, which of course is causing some additional scrutiny and documentation through underwriting. So hopefully that helped. If you have any questions, let me know.
We do have a question. Joe, are banks still considering income from rental properties or short-term rentals?
That's an excellent question. So in my world, Airbnb, short-term rentals, we can't use that up front. However, unless you've owned an Airbnb property, right, forever, for 5 years, 4 years, and we see it on your tax return, then we can use that higher short-term rental income for qualifying. However, we are seeing in underwriting, if I have a client that has rental properties, it's usually recorded on a Schedule E of your tax return, and we need that rental income, underwriters have been asking us to document from the borrower that they've been receiving their rents over the last couple of months. So although it's on the tax return, that's typically all we need. We know that through the CARES Act, tenants can call their landlord and say, I can't make my payment. Okay, that's legit. And the landlord can't evict that tenant, which is a good thing. But if I have a client who is a landlord, we will ask for bank statements and cancel checks to show that they are still receiving their rents, that their tenants haven't asked to not be able to pay rent.
Do you know of any lenders that are committing to maintaining lower credit score requirements and standard down payment mortgage products?
Several of us out there that are adhering to the industry guidelines as far as credit scores. There are some that are raising it in anticipation that it could get worse. Okay. I don't know of any that are at, like, for argument's sake, government, we could go down to 580. We're at a 640 now. So those have gone up. We still have those of us that are adhering to industry guidelines, but if you have a 600 credit score, you're not going to be able to get a mortgage. Those are just not out there right now. They may come back, but not right now. So the industry is tightening up.
Someone's also asking if you can just elaborate a little bit more on, you made a statement that jumbo loans are drying up. Can you just explain that a little more deeply?
Sure. So the jumbo loan would be the non-conforming loans. When I mean that, your Fannie Mae, Freddie Mac, those are your conforming conventional. You have your government, FHA, VA, rural development. Jumbo is higher loan amounts. That's the best way. You're buying $1 million house, you're putting down 200,000, you need to borrow 800,000. That's a jumbo loan. Those loans are not backed by Fannie and Freddie. It's banks that lend that money or private investors. In this environment, those banks have really ratcheted back on that type of lending. You can still get a jumbo loan, but remember, if I'm quoting you 3.5 right now on a conforming loan, I just priced a jumbo the other day, and that rate was like 4.6 to 4.8, and you had to pay a 1% origination fee. So they still exist, but the interest rate is a lot higher than market, and you may have to pay some additional points to get that.
Can you also repeat what your explanation of what's going on with PMI?
Sure. So PMI is the insurance that is there in the event that you're putting down less than 20%. It's required by lenders. That private mortgage insurance premium is starting to increase. Okay, we've already seen increases. So it's an anticipation that we're going to have a rough ride ahead for a while as we plow through this recession. Okay, so the PMI companies pay the investors in the event of a default on a mortgage. Therefore, they're raising their premiums, okay, to combat claims that they may have to pay out. Just like if you're a homeowner's insurance company, right? Homeowner's insurance is more costly in Louisiana because of hurricanes. Whereas if you're in, I don't know, Arizona, your premium may be $1,000 a year, whereas in New Orleans it may be $2,500, because the risk of disaster is greater because of hurricanes, whereas you're in another area, it may not be. I'm just trying to give that equivalent or comparison. So PMI companies are expecting we may have to pay out some claims because of default, therefore they're raising their rates.
Great, Joe. We also have a question about physician loans and the benefits of a physician loan over a traditional mortgage.
Right. So physician loans, not every lender offers a physician loan. Those would be 100% financing if you're a doctor, just got out of medical school, without PMI. Those are very specific to the banks that offer them. We don't have ours right now because we cut it out. So that is a loan. If it's 100% financing with no PMI, you'll have to check to see which banks offer those. That would be a loan that if I was a physician, I may not count on that right now if investors are tightening up their mortgage lending right now. But it would be 100% financing with no PMI if you're a physician.
Great. And we have one more question for you, Joe. And this will be a great segue, I think, into Gordon speaking about the commercial market. But someone would like to know if banks are considering interest-only payments for commercial loans, and also how long are banks typically deferring payments on existing commercial loans?
Great. I don't work on the commercial side. I know enough to be dangerous. There are many commercial loans that are interest only, even before COVID. Okay, so commercial loans can be set up a lot differently. Our bank does not want to, no bank wants to see anyone go into default. They just don't. They're not in the business to take properties back. Everybody loses. So all banks are working with their borrowers to work things out. If you're in a situation where you have to cut back on your payments, eliminate your payment until you can get back up and running. Again, I think I'm answering for all banks that they are willing to work with their borrowers throughout this. It's not a free ride forever. Eventually, you have to make those payments, but banks are doing what we call workouts if you're in that type of situation. So great questions.
Great. I think this is a great time to sort of move over to Gordon's analysis of what's going on in the commercial market. I see there are a couple more questions that are loan related, but with specifically with regard to the residential market. So we can sort of reopen that conversation a little bit in a few minutes. Gordon?
All right. Thanks everybody for being here today, and thanks to the PRC for putting this together. I had a lot of fun yesterday evening preparing for this and really diving into the commercial database and getting some market touch points to share with you today. Just to follow up on what Joe was saying about commercial lenders and forbearance. We are seeing commercial lenders provide 90-day forbearance and temporary mortgage payment arrangements, but you got to ask. They're not going to call you up and say, hey, the mortgage payment that you owe us, you don't have to pay that for a while. You got to call the bank and work it out with them. But I think Joe's absolutely right that they are trying to work with everyone to prevent foreclosures and defaults. Driving down Magazine Street today is kind of scary, to be honest with you. But mostly folks and businesses are trying to flatten the curve and weather the storm. Uncertainty can hurt critical points in the New Orleans real estate market, but it's a long game, and this is a temporary market condition. There will be a ripple effect down the road, but we're looking at this as a temporary condition. And luckily for us, real estate is part of our economy that can continue and operate while maintaining social distancing requirements. It's been very refreshing for me to see market players working together and adapting to this temporary disruption and continuing to transact in a safe way. Very proud of how creative we've become to continue to conduct business. And I think Katie's going to touch on that a little bit more lately. But just as an aside, the title work and showings are being done differently. But in commercial world, we do a lot of DocuSign and wire transfers. Traditional closings are still happening. I actually became aware that Winter's Title is conducting closings where everyone stays in the call, continuing to conduct business. I'm also seeing landlords that are providing rent forgiveness and deferred rent options. For small business New Orleans, everyone's trying to work together to weather the storm. It was great to see local banks helping so much with the SBA loan applications. They were slammed before that with refi requests because of the low interest rates that Joe alluded to earlier. So, it's a buyer's market right now. I see it remaining that way for the next 6 to 12 months. This happened almost overnight as the stay-at-home order was mandated. That said, we have a very steady flow of offers, contracts, closings, and even new listings. I received 2 offers for property yesterday, and I'm preparing to make offers for clients later on today after the call. We have seen some contracts get extended, sure, rather than closing on time as scheduled. Lots of these are related to hospitality uses, but we're still transacting. And guess what? 200 out of the 276 commercial properties currently listed on the Louisiana commercial database, 90 are historic properties in New Orleans. That's 1.2 million square feet of our built heritage. And, I've personally got about 100,000 square feet of commercial historic shell property under contract all over the city, including Mid-City, Bywater, Marigny, and Warehouse District. And all of those properties will be redeveloped using historic tax credits. Let's not forget also that we have over 2 million square feet of historic tax credit projects currently in construction. That's, the two big ones are Charity and the World Trade Center. So that's a lot of market activity that's still happening. I do think that the COVID related delays could change the bottom line for those massive development projects. And there's a looming state tax credit sunset. So one of the silver linings I identify in all of this is that this actually may help us get our state legislature to extend the state tax credit. I've even heard discussions of maybe even getting it back to 25% and maybe even doing an additional bump for multifamily housing conversion. I think we have an even more compelling argument to continue this proven economic driver to help with the COVID recovery. So I do see that as the silver lining, that we may have a better argument for continuing with the state historic tax credit. So what's selling? Cash is king. That's generally true for commercial real estate. But commercial real estate is often competing with Wall Street for the same capital. There are currently nearly 39 million in commercial real estate contracts, according to the commercial database. My company has 22 million in contracts currently, and we've had 15 to $20 million in closings in the past 2 weeks. According to the McHenry residential team, they're averaging about a contract a day. Lots of home sales in the 300 to 500,000 range. Low income multifamily is actually trading really well right now. Lots of contracts and market activity. Some retail, especially retail that's selling essential goods, is doing really well right now. Obviously, fast food takeout's doing fine. Grocery and pharmacy are all gangbusters because of the virus. Dollar stores are crushing it right now. People got to get essential goods, and so those sectors of the market are actually doing a lot better because of the virus. Let's see what's sitting on the market. New restaurant spaces, any kind of startup, nonprofits are all basically on hold. Traditional restaurants are getting crushed, and many are trying to adapt in order to keep income for their employees. But lots of them aren't really equipped to, do curbside pickup and family style meals. We will see changes in how some businesses operate as a result of this. We will see an even softer local office market. Downtown office towers may be in big trouble. I think this virus may also eliminate co-working concepts, which have been a popular startup across the country recently. So kind of goes without saying, but New Orleans tourism has taken a major hit in the interim. It's recorded the steep decline in RevPAR, which is revenue per available room, is down 92% to $10.27 per room. That's nothing. So many hotels have partially shut down or closed altogether for the time being. Regardless of whether it was the right move, the announcement of no more festivals this year should push out our recovery even longer. The long-term outlook for New Orleans tourism is still strong, but it's going to require a restabilization period. 9/11, Katrina, Great Recession indicate that restabilization period could last anywhere between 12 months to 3 years. But this is a very unique virus, and the stabilization may occur more swiftly, and I personally think it will. I have a spreadsheet just to add a little layer to the hospitality industry. A lot of people don't think about hotels as having mortgages, but they do. And we have a CMBS spreadsheet that shows 1.3 billion in outstanding mortgage balances for hotels in New Orleans. That's 66 different hotels in the metro area. Looking at multifamily, the absorption rate due to recent completion of large multifamily properties downtown, coupled with the influx of furnished former short-term rental properties, is flooding the market a bit. And this is actually really good for renters. I think that the smart money is going to snatch up some of these short-term rental properties that cash flow is multifamily. I also think that, let's see, I have the same CMBS spreadsheet shows 257 multifamily housing properties in Metro New Orleans with a total of 2.28 billion in outstanding mortgage balances. So when you think of, 100-unit multifamily property and 80% of your tenants all of a sudden can't pay rent, there's, the owner of that property also likely has a mortgage on the property, and it's all a ripple effect, and it's all related. Let's see. I did read a report for the data center that suggested 172,000 jobs are at risk in New Orleans, which is a lot. We've worked through an internal analysis on the impact of the potential job losses, and it suggests a reduction in value for multifamily properties. I could talk about industrial if anybody's interested. Essentially, the Port of New Orleans has made a strong push in recent years, and they're doing pretty well as a economic stalwart for our city. So where are we headed as a result of all this? The McHenry Company appraisal platform is experiencing a healthy flow of refinance requests. I'm sure Joe can speak to that. Our firm has recently worked on the former Warwick Hotel, the former Dryads Food Market on O.C. Haley, and Mercy Hospital. We're also engaged on Charity Hospital redevelopment and some other interesting historic tax credit projects that are moving forward. Historic low interest rates coupled with growth in the tech and healthcare industry continue to make New Orleans an attractive market. The decline in tourism, however, is troubling, and I think we're going to end up with a 12 to 24 month stabilization period to get back on track there. Again, the Port of New Orleans continues to provide a strong economic base. And additionally, the outlying areas of New Orleans are seeing growth in the petrochemical expansion, which should help GDP over time. We're kind of insulated from oil and gas. It's in a slump, but we've kind of diversified our local economy outside of oil and gas since the bust. The interest rates and the infusion of significant stimulus money should result in softening the contraction of the market conditions and buoy commercial real estate activity. I think multifamily and lodging hospitality will take a hit in the interim, but cautious optimism. I think we all need to do our part in social distancing so that we can bounce back quicker. But I have a pretty good report, and I think we're going to be okay. I really do, and I'm so proud of our city and the way we've adapted and adjusted, and Katie can speak more to it, but I really think that our industry has pivoted and done so very successfully in maintaining business as usual. We're technologically equipped to persevere in our industry, and I'm very thankful for that. I'll be happy to answer any questions if there are some.
Yeah, Gordon, we had a question about what you were saying about co-working spaces. Are you thinking that new co-working spaces or existing co-working spaces will take a hit, or both?
Yeah, so this is just kind of this is just a personal opinion. I have a hard time seeing how they're going to persevere through this virus, and I also think that that once it's all said and done and we have an opportunity to study the spread of the virus and everything else, that I think people will be less inclined to want to work with people that they don't know. And I think that, we're finding that a lot of people can work from home. We're also finding a lot of meetings that were in-person meetings that were unnecessary and could have been conducted the way we're talking right now. So I think that it was a very popular concept, but I just think it's going to have to face some challenges right now and moving forward.
Gordon, do you think that commercial STRs will take a hit in the same way that hotels might be?
Absolutely. They absolutely are. We have a market that's being flooded right now by furnished rental property. And, you know, like I said earlier, I think that the smart money will absorb the short-term rental properties that cash flow as traditional multifamily properties. So we will, in all likelihood, experience a shift there.
There's a follow-up question to that, but I'm actually going to use this to plug another class. Someone's asking, what happens if the legislature does not extend the sunset date for the historic tax credits? And feel free to give a brief answer on that, but also on the 22nd of this month, we're doing a full session on tax credits where we'll be really deep diving into that conversation.
It's great. It's important. You know, I can, in my analysis, looking at, you know, how many properties are under contract and what my personal workload is right now, we're trading a lot of historic shells that are redevelopment opportunities, and historic tax credits are critical for those projects to pencil. And so when you take a 20% haircut on your pro forma for the state tax credit amount for the qualified rehabilitation expenditures, that is a significant number. And what it does is it makes some of these projects, you know, not financially viable. So I do think that we need to extend it. I think some of these projects would be in jeopardy without it. I don't think Charity Hospital will be complete by the time that the sunset happens. So if it does sunset, we need to be very deliberate about how we treat projects that are already in process, already in finance, already in construction. But, you know, I think my hope is that we can get it extended, and maybe even with the extra 5% that was removed several years ago. There's lots of discussions happening about that, and I look forward to the class. What you said, next week?
Yep, next week.
Yeah,
the 22nd, 2:00 on Wednesday.
Yeah, we all need to be supporting Louisiana's tax credit coalition so that we can educate, you know, this new crop of legislators. We have a 30% turnover in legislators. Most of our local delegation who carried the credit all those years are not there anymore. And so we have to educate the new legislators and hope we can get that thing done. It's important.
Thank you, Gordon. I don't see any other questions right now on the commercial market, so we're going to turn it over to Katie.
Great. Thank you.
Thank you.
Good afternoon, everyone. I just really want to mimic that real estate and preservation of buildings are key drivers in the national, but very much in the local economy. And I'm going to hit on from the residential lens perspective and share some primary and secondary research. So as we know, evictions and foreclosures have been halted. And on commercials, it's a case by case. The order actually doing the evictions did not specifically specify residential or commercial for evictions. So, you know, what we do know is that rent is being paid overall. However, people are now getting their unemployment. It took about 2 weeks for that to come into people's bank accounts. And now with the stimulus package, you know, most of those hit on Wednesday. So that just really covers April rent. What's going to happen for May and June and sort of moving forward at that point. What we know is that real estate is an essential business. The courts are still open and working with a skeleton crew. We also have the 10 layers of real estate, you know, the people that are transacting, the buyers, the sellers, the mortgage brokers, you know, the inspectors. People are still working. However, how we're doing business is that homes that are vacant are more easily shown than homes that are occupied. So I'm seeing an automatic shift there, because if you have a home that has family or elderly or tenants and you're making appointments and you're bringing people in, you know, you're not social distancing. So, and where you expect people just, you know, to be outside. So there's some difficulty there. So there's a lot of home inspectors too that are just inspecting vacant properties. So I definitely see that those homes are going to get sold more quickly than homes that are being occupied. what we're doing when we're showing homes is that listing agents are going in and turning on all of the lights, having booties and having gloves and just opening everything so that the buyer doesn't have to, or the tenant doesn't, have to touch anything. And then, the listing agent is usually outside or somewhere on site for the property. So we have reacted quickly on that and how to get people in. And I can even see people are now asking, the consumers are saying, where's my virtual tour? That's an automatic question. So I've seen a quick shift there on how people are actually viewing property. Because as I said before, real estate has actually been one of the industries that's taken a long time to actually move over to technology. I think Gordon and Joe made a good point that it's been the last couple of years, but really we've sort of chugged along, and now it's really forcing us to use technology very quickly. We've had to adapt. And I want to talk about some very specifics. What do we know? Is that we know that we're going to have a stalled market, a delayed market, but serious buyers are looking. And I've really, gone through and looked at who those buyers are. And buyers entering the marketplace, anyone in hospitality, has filed for unemployment, maybe have gotten their stimulus package. It's going to be 6 to 12 months at a minimum that maybe they were saving for home ownership, and that they're just not going to be able to. We're going to have a much larger inequality gap here among sort of that first-time home buyer that was really going to try to be able to enter the marketplace. Buyers that have employment confidence are going to be those essential businesses, people in healthcare, education, groceries, delivery services with Amazon and FedEx. Those buyers that feel like they have employment confidence are considered serious buyers. And then buyers, we've had an influx of buyers who suddenly overnight have felt that the market has turned to a buyer's market, which it absolutely has. Now, sellers, I know I've got you on this call as well. That does not mean not sell your property. It means that pricing at the top of the market is not going to be smart. So work with your realtor, look at what that data over has been the last 6 months. And really my sort of, KPI that I'm looking at is what homes have gone under contract since March 15th, when the stay-at-home order came into place. And so I looked at just the historic markets, example from Algiers Point to Gentilly, from the Bywater into Mid-City. And currently, from March 15th to year-to-date, April 17th, there's 35 properties currently that have gone under contract. This time last year, there were 196. So that means that there is, 5.5 more times properties that were under contract at this time last year. So I'm definitely seeing, our last week we had 45% of our showings were down from that time last year. And now I just looked again and it was 40%. So we've actually had an increase in showings just from last week. I want to go ahead and look at Gentilly as an example. I did an analysis last night and I looked at homes in the greater Gentilly area and then went ahead and looked at Gentilly Terrace. So sort of taking a macro view, going to a micro view. And I thought it was really interesting to share that homes that are listed for sale in Gentilly are actually listed for sale than $6 a square foot less than homes that had sold within the last 6 months. And then if I actually go to Gentilly Terrace, homes are listed at $20 a square foot less than what they had sold over the last 6 months. So that is a strong indicator to show that there has been a shift. I do not see any fire sales happening here, but I definitely see the affordability of homes is going to become more attractive, and that it is going to shift from a seller's market to a buyer's market. And frankly, for 10 years, it's been a seller's market. That being said, I think we really have to see what do we want housing to look like post-COVID. And, Gordon had mentioned it with the historic tax credit. That is huge. It's a huge economic engine for our properties to get renovated, but also what does housing look like? And we really have to come together with public policy to sort of see what these changes are in place. lastly, I don't think I mentioned this, but if you are having trouble paying your rent, there are resources for you with Total Community Action. So go ahead and go on their website and see how to apply or be able to help, one of your neighbors or what have you. Make sure that people know that there is some relief for helping with some rental payments. I think in closing, it's really important to be the voice of value and try to find reliable resources. When Katrina hit, we didn't have text messaging. We didn't have all of this, and we're all inundated with just a lot of information and messaging. So you just really want to make sure that you're getting proper information and really relying on those reliable resources into the marketplace.
So we do have a few questions. So with regard to, you mentioned that it looks like asking prices are coming down by square foot, by price per square foot. But does it look like the offers coming in are coming in at asking or below asking at this point?
So I only want to talk about the residential market. I was already starting to see last quarter, last year, and first quarter in the beginning that people were not going in at full price. Most things have sold historically at 95% of list price in Orleans Parish, and that can adjust. Bayou St. John, 98%. It's going to be a little market adjustments. I do not see buyers coming in at full price. I see them coming in below that. Is that going to be a 10 to a 15% and starting a conversation? I'm absolutely seeing that. Yes.
Another person was noting that they seem to be seeing on wherever they're looking at properties a large variation in the prices for houses based on similar square footage, what they're sort of able to pull as comps or notice as comps, comparable properties. Do you have any insight to what they might be noticing in that? Is that a trend? Is there great variability in the way things are being, in the prices that things are being listed at right now? Or is that maybe a fluke that they happen to be noticing?
I'm wondering if they're referencing Zillow and the Zestimates or Redfin, and they also have the Redfin estimate as well. In a historic market, you have to be very careful because it's just based on public data and zip code. And so it's not factoring in also the condition and the amenities of the house. So you may look at the assessor's website and see two houses that look like they have similar square footage, but the updates on that particular property and the lot size will absolutely adjust the value of the house. So if you actually even just Google, the Zestimates in Louisiana, you can tell how off they are. There's been several articles written about that. So that could just be used as a tool, but you have to be able to get with a resource that understands your specific neighborhood to help guide those values there.
Thank you. And we've had a couple of different variations of a similar question about sort of timing. It looks like we've got some people who are looking to purchase properties and they are wondering what your perspective is on whether or not they should be looking right now, diving in right now. Should they wait a little while? And these questions have come for you, Katie, as a realtor, but also for Joe, with regard to sort of obtaining a loan and whether or not it would be better to wait a little while.
Joe, I'll take that just as a start because I've actually had several calls today from buyers wanting to know, should we start looking now? Maybe we had initial buyer sessions and they thought they maybe put it off for 6 months or even 3 months. And I think it's important for people, if they're interested, to actually get their financial documents in order because the banks are inundated with the refis, and to make sure that they have all of their paperwork organized so that they can send it to the mortgage broker and see if there's any actually issues, with their file or things that they need to be able to work on, because this is a good time to be able to do that. So I think going ahead and doing your homework is just like a foundation of the house. Like you have to figure out what you're getting pre-approved for before you can actually enter in the marketplace. You have to start at that base level. And I think by looking online, most buyers look online about a year and a half before they actually look at properties. So going ahead and getting pre-approved and then looking at property now is probably a good time, because they probably have a little more time than when they go back to work full time. Just to follow up on that, nationally, most buyers nationally look at, before COVID, at 9 homes before they made an offer. I saw a recent stat this morning that said that buyers are looking at 3 homes and making offers. And just to let you know, sort of post-recession in 2010 to 2012, when we had a lot of shadow inventory in New Orleans, most buyers were looking at around 21 houses before they made an offer. So I would say it's a good time. You never know when the market's going to sort of bottom out, but if you have time right now to get your finances in order, it's a good time to learn the market. You got to learn the market before you can actually jump into the market.
Yeah, and Katie, excellent points. I would also say rates are great. Don't time it because of interest rates. A lot of people try to time it. And as I said, I think we're at a great spot where there'll be a little up and down from here. Also, if you're approved now and the right house is out there, the stars have kind of aligned for you on that deal. You know, we may get in a situation where sellers end up losing a job or something, and then they back off from selling their house. The same thing may happen to you as a buyer, where right now I can get you approved, and 2 months from now you're in a different situation. Not that any lender wants to put a buyer in a situation where you can't make the mortgage payment in 2 months, right? We would want you to make that decision. If there's a chance, hey, my industry is teetering on being in trouble in a few months, don't buy that house, would be my advice. But everybody's got different resources, right? Hey, Joe, I'm good. And I have family resources to help me through it. So if it feels right, if it's the right house, rates are great, go ahead and complete that transaction, because there will be a lot of uncertainty. And one of the trends that I mentioned 2 weeks ago was that when we come out of this, there may be a lot of sellers that are backing off listing their houses because of uncertainty in their lives with jobs and things like that.
Thank you. That actually leads into another question from someone who's looking to sell their property. They are wondering if either of you have any thoughts on whether or not they should just sort of do it right now, or wait. If they know they want to sell in like the next 2 to 3 years, should they wait or just get it done? What's your estimate on timeframes for that? And I think just your perspective would be welcome, either of you.
Gordon, are you comfortable answering that? Maybe. Okay, we'll wait for
Sorry,
Gordon.
I was tending to a grocery delivery. What was the thought?
It's a seller asking if they should wait to sell if they know they want to sell within 2 or 3 months, or should they just go ahead and try and sell now?
You know, that's a tough question. I would encourage my client to go ahead and put it on the market if they need to do it quickly, but to temper expectations. You know, it may not be possible to sell in 2 or 3 months, but I don't think this is a time to not list property for sale.
I agree with that. I just went through our database, and most of our sellers currently that were listing, you know, April 1st to April 15th are now more on a May 1st to maybe a May 15th date. So there's been a delay of about 15 to 45 days for, you know, various reasons. But I'm just starting, even since we've had our last call, starting to have more buyers, you know, become more alert. And I mean, everyone's always looking at real estate. It really has become America's pastime. But, you know, serious buyers, I don't think you want to miss that opportunity. And they're out there. Anyone, you know, that is in the medical field or education, which is feeling secure with their job, as long as they haven't been affected, you know, by COVID, they're actively looking. So I wouldn't want you to miss those serious buyers. And in the end, that's who you want looking at your house anyways, are serious buyers that are organized and have their finances together.
Right. I have several buyers who are well qualified that are looking for houses. So if you're a seller, it, the buyers are out there.
Yeah.
Again, Katie's given and Gordon has given numbers on how the numbers are down transaction wise, but we're working. And again, just keep that in mind. There's never the perfect time to do anything, but I think with rates where they are, and there are some serious buyers out there, and as Katie mentioned, the ones that are in the market and pre-qualified and pre-approved are serious. So don't let that stop you.
Yeah, I'm sorry. I was checking to see if I was on mute, but my what I'm seeing is continued market activity. It's not as strong as it was before this all started, but you know, I've seen some buyers, sellers, and even brokers say that they're going to sit this one out and wait for things to come back to quote unquote normal. But they're missing the market. They're missing buyers. They're missing sellers. They're missing good properties. So I think now is not the time to just say I'm going to wait indefinitely. I think it's if you need to sell your property, then you should put it on the market.
Great. I've got some more questions for you guys. Someone is asking, I think this is probably directed to Katie. What is your perspective about houses that have been sitting on the market for, over a year, for a long time? Is now a good time to get a good price on a house that has been sitting for a while?
I always say you can pick your house, but you can't pick your seller. And last night I showed something that has been on and off the market for 5 years. And I thought, well, maybe this is the opportunity for this buyer. I have shown it multiple times, literally on and off the market for 5 years. And I thought, maybe this is the time. But talking to that seller, I mean, you would think he had it on day one. So I really think it depends on the seller's particular situation. But I have to tell you, I'm encouraging people, start a conversation. You just never know what's going to come out of it. And what's the worst that happens? They say no. I mean, I know in the commercial world, Gordon could probably comment on this, but you can write multiple offers on properties and, it's always told no. And then all of a sudden you write an offer and they say yes. So I think if you have the time and the energy, that's the other thing, if you have the energy and the health to go through the process, then I think you start a conversation with people because you just really you're not certain if their situation has changed. I always think sellers, it's good to write offers at the end of the year when their tax bills come out, because it's always such a, oh my gosh, I can't stay here anymore. And you just never know what their situation is.
Thank you. We have a couple of questions about the any differences in or variations that you're seeing in different local markets. So Orleans versus Jefferson Parish, different neighborhoods within town. Are you seeing different trends in different areas?
I don't think so.
Yeah, I don't either. I mean, I lend in all over the country, but mainly in Louisiana. But no, I mean, if the deal is right and it's happening, but I'm not seeing different trends between Jefferson Parish, St. Tammany, the river parishes, or Orleans.
I'm not necessarily
outside of typical market conditions. I don't think that the virus creates a market condition that changes the desirability of a particular locale. I mean, AAA locations are always going to be AAA locations. I mean, the price and the buyer and the seller may change, but I don't think a geographic area is particularly better suited because of a health emergency.
Correct.
Great. Thank you, guys. Okay, so I just want to be cognizant of the time. It is after 3 o'clock. So for everyone who is here and needs to go, thank you for attending. We really appreciate it. Again, Thank you so much to our PRC members and regular supporters. I see you here in the room. Thank you, thank you, thank you. Please do consider becoming a member of the PRC. We have a wonderful magazine that I didn't even mention before. Preservation in Print is such a wonderful, not only a resource in terms of learning about the city, it is a beautiful, enjoyable magazine that's delivered to your door 9 times a year and that you receive with membership. So please consider joining. For those of you that are able to stay, I think that our panelists have a couple minutes to answer a few more questions. And I see there are a bunch of different questions in here, so I'm trying to get to everything as quickly as possible, but I just wanted to say thank you for those of you who do have to leave. And now I'm gonna just continue on. If you guys have a couple more minutes, Katie and Gordon and Joe, we have about 5 or 6 more questions that I would love to ask you.
Yeah, let's go
okay, so someone has asked specifically, if properties for sale are currently categorized as contingent, is there a greater chance now that those deals might fall through?
Ooh.
I would say yes, but it depends on the type of asset. I mean, if it's a house, depending on if the buyer's job situation is all of a sudden different, those types of things can affect it. In the commercial world, we are seeing delayed closings, extensions being granted, especially as it relates to redevelopment plays, or especially hospitality, restaurant, those types of businesses. So I would say yes. There's a distinct possibility that a pending sale may not happen, or just simply may not happen on the same timeline it was previously planned to.
I agree. When we did this a couple weeks ago, everything that we had in the pipeline has closed, and maybe a couple had a handful of delays. But now I'm really specifically looking at what went under contract, from March 15th and sort of moving forward. And I think if something is contingent, it's probably a good time to write a backup offer on that if it's a property you really like. Just to be able to see, because you don't know, that particular individual's situation. And in Louisiana, there's on the residential contracts, there's anywhere, 7 to 14, 15-day inspection period that a buyer can change their mind and get out of the contract, which is very unique to our Louisiana contracts. That's not a contract that we see, nationwide. So I think it's a good time to submit other offers on properties.
We also have a few questions about residential rents and sort of if COVID-19 is having some sort of an effect on residential rents, and also if multifamily properties and sort of where they are or are not selling is impacting rental income and the and rent rates.
Gordon, I'll jump in there just quickly. I started seeing that rents were actually starting to decrease in the historic neighborhoods, and that it was taking your typical half of a shotgun double up to 90 days to rent, which I had really never seen before. And that usually, it would take 30 days to rent. So I do see that rents are going to be coming down. I always look at Magazine Street and St. Cloud Avenue, sort of those indicators of like what's going on in the commercial market, and then how is that actually going to translate to the residential market. I think, South Market and any of the downtown developments, I don't see rents being adjusted greatly, but I think in the historic neighborhoods, also because customer preferences have changed, and not everyone wants to necessarily live in a shotgun and a walk-through anymore. And so rents are going to have to go down because of consumer preferences.
Yep. I think the only thing I'll add to that is that absorption rates for all the new multifamily that has been built downtown, including South Market District, the Julia, the Garage, all of these buildings, people choose to live, in a place that's downtown with all of these amenities rather than a historic house for the same rent sometimes. But I do think that our rents uptown and for older homes will decrease as a result of all the new inventory downtown. And we're already seeing that.
We just didn't know in our market that new construction layouts. I mean, we had no idea that you didn't have to maybe share a bedroom or a bathroom. I mean, it's just the consumer preferences have changed. You have to think post-Katrina. You know, we started seeing new construction, but we're in a historic market, and we just didn't, you know, that the consumer preferences have changed on what they actually want.
Yep. When I was with I was the chief of staff for Councilmember Guidry several years ago. I had a lady, a realtor actually, who called me almost every day, but at least once a week, to tell us that we needed to stop issuing building permits because she couldn't rent her properties uptown. And I think for a long time after Katrina, we had a supply, an inventory of property that was livable and able to be occupied, which drove rent up. And I think what we're actually seeing is, you know, just coming back down to earth for some of that. I think people who own properties uptown got used to a certain level of rent, and going back to normal, so to speak, was not something that they really wanted to do. But so there's that too. But I think it's a supply and demand thing, and we do have a lot of new inventory. So the absorption affects rents for existing properties.
So just to follow that up, do you see or think that the shifts in the market right now are having a specific influence on on these new construction multifamily projects, luxury condos downtown?
I don't have any direct insight on that. I'm sure that all of a sudden it's a little more challenging to lease because, you know, showing is not happening as often. I mean, these are rental properties. These are not condo buildings. So I don't know though. That's an interesting point. I would actually like to know the answer. So perhaps I'll find out and report back to everyone.
Okay. Do you, someone is asking if, what you guys think this will have, what kind of impact you think all this will have on, the short-term rental market?
Yeah, I mean, it's our entire tourism industry is hurting right now. That's restaurants, that's hotels, that's, you know, short-term rental properties, bars, anything that is dependent on people coming to our city is experiencing a significant challenge right now. You know, some properties will probably not remain as short-term rentals after this is over. People will not survive the, you know, lost revenue and can no longer afford their loans on it. So, you know, there's that. I alluded to that earlier. We have an absorption of not only new multifamily that's been constructed, but we also have absorption of furnished short-term rental units that are now being advertised for lease. So yeah, I think short-term rentals are going to take a hit for this. I do think that it can recover though.
Okay, so actually someone had asked a question about these furnished rentals and sort of what's going on with that, and also is that a static situation, or do they have to be rented as furnished rentals, and sort of why is that happening?
Well, it's happening because, you know, short-term rental units are furnished, and you know, instead of moving the furniture out and, you know, listing it that way, I'm sure that the owners of the properties would be glad for someone to bring their own furniture if they wanted to. But, you know, a furnished rental is typically a little more than, you know, a non-furnished rental. That's why it's happening.
Mm-hmm.
Great. Gordon, a couple of people are now asking questions about your mandolin, so I'd like to talk.
I didn't think I could see it.
We can see it and hear it.
Oh, really?
Yeah, let's end with a song. Gordon, you got one?
No. It's not ready for prime time yet.
All right.
Sorry
This has
about
been
that.
great. Thank you so much, Sarina.
Thank you guys. I appreciate it.
Yeah, this is a lot of fun. Thank you, everybody. I appreciate the discussion, and thanks for giving me an excuse to dive so deep into our market and to share some touch points with you.
All right. Thank you everyone for coming. Hopefully we'll see you at the next one. If I missed any questions, and I'm sure I did, there were a lot of questions coming in. Please email me. I can connect you with any of these presenters that would have the best answer, get you any other information that you need. And as always, if there's a topic you want to learn more about, if there's something you learned today and you want to dive in deeper, let me know. We can think about setting up some more classes on any topic that we all find interesting. So please reach out. Let me know if you have questions, comments, insight, etc. My email is smohan, that's SMOHAN @prcno.org. And hopefully we will see you all soon. Thank you, Joe and Katie and Gordon.
Bye-bye.
Bye. Thank you.
Bye.